My name's Olivia Hartridge. I work in Morgan Stanley's commodities department. I'm in origination. I cover UK and Nordic countries for gas, power, emissions and coal. So I'm basically structuring products for our clients and working with our trading desk. Today I was asked to give a presentation on the UK gas market from a global perspective. But I'm afraid I am going to do the same thing as Christian and very briefly give an overview of what we do, but it's going to be the short and sweet version. Morgan Stanley is one of the top 10 traders in gas market by size. As you'd expect for European gas business, it's primarily physical, but that's not just because it's a nature of being involved in the gas market, it's because Morgan Stanley in general as a commodities platform is very physically oriented when it comes to, for example, owning power plants, gas and oil storage facilities, having a very large dry and wet freight business, which means that at any one point in time we've got about 100 different vessels on the water. So it's a very natural extension of what we already do, and we cover all sorts of products. What you may not be aware of is that we have an LNG business, which is a very natural extension of our physical gas business, and we definitely optimise the two businesses together. That's just a slide that goes through the number of cargoes of LNG that we've shifted in the last few years, and you can see it's a growing trajectory, and the number of countries where we are off-taking cargoes and number of countries to where we are delivering cargoes, and also being involved in more innovative operations like transferring gas ship to ship via flexible hoses, that sort of thing. It's all there on that slide in case you're interested in finding out more. Anyway, back to what I was asked to do. The danger of going second in any presentation slot is that you end up repeating information. Christian's already given a short insight into the history of the MBP. But I think one of the points I wanted to make is that we had about, say, 8 years or so of the market itself being created, gradual 6 years of this hard landing being achieved, where you go from non-punitive imbalance charges based on average prices to punitive charges based on marginal prices, with tolerance bands gradually coming in and in to the point where you actually have quite a pure virtual trading hub with imbalances being charged on a punitive basis, which is a great starting point for a liquid market. The second phase was really a lot of physical interconnection being commissioned through IUK, Isle of Grain LNG terminal being commissioned, Ormond Lange pipeline being opened, BBL being opened, and then the first tankers docking at South Hook and Dragon LNG, which takes you up to 2009. The thing is, when you look at a map of European gas flows, all that infrastructure that aids the UK power market is not really very different from the rest of Northwest Europe. I mean, you could make a case, for example, for the Spanish market and interconnections with France having more issues in terms of capacity shortfalls, but it's not very different from the rest of Northwest Europe. So why is it that the UK MBP market has been so much more successful as a trading platform? And it has, because you can see that in the next 4 slides, which just focus on traded volume data. This is the spot market, and this is taking OTC as well as exchange information together. The size of the spots on this graph indicate the relative sizes of the market. MBP clearly much bigger than the other hubs and markets. Now, that's just spot. It doesn't necessarily give you a great indication as to the overall liquidity of a market, but it does indicate that the MBP is not just used for the imbalance to balance trades done by a number of the physical trading desks. It's also an indication perhaps of the number of people in the UK that manage their own portfolio in terms of flexibility, rather than relying on flexibility provisions in long-term contracts. So I think there is something, some information to be gathered from just looking at spot data. In terms of how the market trades on spot markets, it's very dominated by OTC everywhere across Northwest Europe. The smaller segments in all of those pies indicate the extent to which there's exchange participation alongside OTC, but it's very much a question of, very much an issue of brokers and bilateral trades dominating the market. When we move to forward markets and looking at data across exchanges and OTC markets for forwards and futures, NBP again really dominates all the other markets, with the exception of TTF, the Dutch hub market, which has really come on leaps and bounds in the last few years. Now, that's, I think, a real indication of the maturity of NBP and to some extent now TTF, because it's indicating that people are moving away from the old-fashioned oil index type contract and using the hubs themselves to manage their risk, price risk exposure. This next slide is just again showing the proportion that's traded as futures and the proportion that's traded as forwards. The only markets where the exchange has really gotten a reasonable share is ICE and also PEG. I mean, on PEG the volumes are so small, I think there's not an awful lot sensible to conclude there. But it's true that ICE has gathered about 38% of the market now in the UK. And it's unclear the extent to which that's really going to increase much further, but it does mean there's a greater balance in NBP than anywhere else. And that's largely, I think, due to the success of the NBP 97 contract specifications and the fact that that was used as a basis for the ICE contract. It means that there aren't many risks, arbitrage risks to be taken trading forwards versus futures. So that brings us back to the question, well, why is the NBP so much more liquid than everywhere else in Northwest Europe? Well, it's not just a question of whether or not the markets existed for much longer than everywhere else. Although I think it's interesting that the market as a virtual hub was established before you had more different types of physical infrastructure linking to that market, whereas everywhere else is the other way around. It's actually mainly because it's the simplest market to trade. I mean, yeah, we've all got technological improvements that enable us to handle more complex calculations, trade structures. But at the end of the day, when a market makes it easy for traders to get involved, then it's not rocket science. It does actually normally lead to a jump in liquidity. The NBP is a true virtual hub. There aren't complications like balancing separate high locale networks, like you have, for example, in NCG and GPL. You also don't have the complications of a physical delivery point like Zeebrugge being interconnected with a virtual hub, which is what is trying to be done with the new ZTP. The benefit of the virtual hub is also that when you're trading under EFET or NBP, you don't have force majeure clauses that lead to the question between counterparties inevitably over, well, who's taking this risk, which leads to the prices basically being increased by risk premiums. It's quite straightforward to obtain a shipper's license in the UK. For any of you out there which have tried to obtain shipper's licenses, gradually going further and further into South and Eastern Europe, you might be aware that there are greater headaches to be had than there are in the UK when you get a shipper's license. It's also possible to trade on ICE without a shipper's license. Access to cross-border capacities routinely available, and less importantly, there's a direct rather than indirect linkage to international LNG markets. There's more of an incentive in the UK for participants to trade NBP because the transition away from oil, so crude oil, gas oil, fuel oil indexation contracts really began to happen sort of around 2000 onwards, whereas it was only in the wake of the credit crunch and shale gas having such a massive impact on Henry Hub and the diversion that you suddenly had between oil and gas hub prices, that's led clients, in particular in Europe, to push towards hub pricing rather than oil indexation pricing in the rest of Northwest Europe. I would say the only downside of the ease of trading on NBP is that it's actually exacerbated the move of liquidity downwards in the UK power markets. There is such high correlation between UK power and NBP. We're talking 90% plus, that if you're going to trade UK power but you struggle to find the liquidity that you're after, then the most obvious thing to do is to move to trading NBP instead. And we've seen that recently. We sometimes are quite a large part of the market on various UK power contracts. That's not a great sign for any market when you want liquidity to grow over time. And we've asked ourselves and former counterparties why it is that they're not there anymore in UK power. And the answer some of the time, much of the time, is that they've moved to NBP instead. I find it a great irony that NBP is being held up as the model gas market structure to other parts of Europe. And yet we have a situation where the existing regulatory framework in the UK plus EMR is now threatening to pull apart UK power market liquidity to the extent that it may move to being more of a tariff-led market than a freely traded market. And that in turn might have an impact on NBP. Maybe it's a prospect that you would see further off in time, but when you look at example for at China launching carbon markets on a regional basis, people say, how would they ever work? How can it work when they don't have freely traded power markets? Well, to some extent, you might have that same issue in the UK at some point in the future. If we don't have freely traded liquid UK power markets, then that might have some impact on NBP. For example, whatever the future shape of gas capacity markets look like, will that actually end up leading to price distortions on NBP? We don't know, but I just raise it as an issue because it's of a concern to us. Two sets of regulatory challenges that I was going to discuss. One regulatory and the second one being market challenges. I'll be brief on this slide on regulatory challenges because Christian spent quite a bit of time on this. Just briefly on EMEA, which is hoping to move a lot of standardized contracts to become cleared rather than remain OTC. In the gas markets, we find that a lot of counterparties don't tend to assess internally the cost of ensuring credit risk when they trade OTC. It's something that we routinely do, but it's not necessarily something that all of our counterparties in NBP also do. And for that reason, when they compare the cost of trading OTC to trading on an exchange, they see the exchange as being an expensive way in which to trade. Also, clearing in gas markets is still relatively expensive. For that reason, there's a big lack of enthusiasm to move to centralised clearing in the gas markets. So I think it's going to be interesting to see the extent to which regulators try to push something which the market's really not particularly enthusiastic about. On remit, we generally support this, although we have concerns about the potential for duplication of transaction reporting between remit and EMEA. But we have seen positive outcome from the increased amount of information that we see in asset availability reporting, which was touched on by Christian. I mean, the gas market is definitely a market where incumbents with upstream assets could potentially have an informational advantage, which could lead to an advantage from a trading perspective. I think those businesses are very aware of that, are very careful about that now, and regulatory changes have also meant that regulators are very aware of this informational advantage, and the flow of information has become a lot better over the last few years. I think the way in which that information is collected and centralised could be improved, but the market's on that. That's not necessarily something that the regulator needs to become concerned about. Third energy package. This should have a positive impact on market liquidity, because vertical integration generally has a large negative impact on liquidity. It's not yet clear to me the extent to which the grandfathering provisions for pre-September 2009 vertically integrated utilities will significantly impede unbundling and therefore impede liquidity growth. It's yet to be seen whether or not these separate legal entities that are established in former vertically integrated companies will actually lead to complete independence of operations, and therefore in reality much more activity going through the market rather than being netted internally. Market challenges for the future. There's a few of these that should hopefully lead to some improvements, further improvements in NBP. We just had a letter yesterday from Ofgem, CIG and NMA that are looking into the efficiency of capacity usage on the interconnectors between NBP and Z and TTF, TTF even. They've pointed out there are still multiple instances of nominations occurring in the wrong direction on the interconnectors. It's true this does happen, although it's not as bad as it used to be. It's curious that it happens. What we would say is that, taking note from what's happened in power markets, market coupling and the generation of automated algorithms calculating the best way to allocate capacity across different markets has removed human error and has led to efficiency on interconnector capacity being improved. So it may well be that gas markets look towards experiences of the power markets in this respect. On storage, a lot of people comment that storage in the UK is insufficient compared to the continent. We would say that LNG terminal capacity as well as new gas storage has lessened the need for new UK storage, particularly given the reduction in demand growth for gas in the UK. It's also the case, to be honest, that there's probably potentially too much gas storage capacity on the continent at the moment. It's fair to say that finding bids for gas storage is problematic to some extent at the moment, just because of the amount that's being sold. However, when we go forwards a few more years in time, when we've got even more renewable generation in the UK on the grid, there's a question mark the extent to which the existing system would cope if CCGTs remain the main mechanism for balancing the power grid and therefore putting a strain on short and medium cycle gas storage in the UK. For me, the main question is the extent to which you actually find demand side management working to take the pressure off the need for UK gas storage, and therefore having more participation from the demand side of the market. And then, of course, the final thing I was going to touch on was the inescapable challenge of European energy markets needing to adapt to international market signals through the LNG. How much time have I got?
2 minutes.
Right, good, fine. In that case, I'm going to speed through those 3 slides on LNG, which you will have seen before in terms of new production and demand centres, and just go through the conclusions, where I was just going to say, in that respect, we've got an NBP market, which is definitely a model for other continental European gas markets to follow, and that's being recognised through the target model approach. There can be big changes in a short space of time. We've seen that through the success of TTF in the last few years. The most exciting development in the future is probably going to be a new Eastern virtual trading point in Austria in 2013 being created, with basically Baumgarten hopefully becoming simplified, and liquidity might take off thereon. Going back to the point I was going to make on LNG, the next big game changer that everyone talks about is the issue of shale gas, and the extent to which export licenses might be granted, meaning that the export of LNG from the US becomes the next big flow on top of the Middle East and Australia. I think it's interesting because for me the impact is already there, and it's more a question of the extent to which energy being exported currently in the form of coal, and also in the future in the form of increased petrochemicals production in the US, additional fertilizer production in the US, and if you have a gasified transportation network in the US in the form of oil products being exported from the US, that means that shale gas now and in the future is going to have an impact on other energy markets. And that probably means that it's somewhat inevitable that those export licenses are granted, because you are going to end up with higher gas prices in the US come what may. The main query in my mind is the extent to which the regulators in Europe respond to that, and begin to realise that it's primarily price distortions created from policies that remain the core issue, for example the carbon price floor in the UK, whereas the gradual trajectory of increased liquidity from virtual hubs isn't really being challenged. So that's my major concern going forwards. It's not really additional liquidity growth coming from virtual hubs and increased physical interconnection and an increased LNG market. It's more the fact that you still have real price distortions being created through policies and the regulatory uncertainty, and therefore the impact on liquidity those have, which is what the traders in these markets have to deal with. Thank you.
Thank you very much. Okay, we have some time for questions. Who would like to put some questions? Oh, we have one over here. Peter.
I wanted to ask you a question about the European target model. I think it was mentioned in a couple of presentations. Do you see that as a threat or a benefit to liquidity in the UK? Because some of the proposals are about coupling markets together, like we have in the electricity markets, day-ahead auctions, implicit auctions, linking access rights and energy together. Do you see it as a threat or an opportunity?
I think it's probably more an opportunity rather than a threat. I would become concerned when you have the potential for liquidity to be shifted from one platform to another. When you, for example, you try and create a virtual hub, but there are still complications with balancing on individual networks within that hub. But when you've got increased efficiency being created, and I was saying, through market balancing in the power markets, you've definitely reduced the scope for human error to reduce efficiency, and that's more of an opportunity than anything else.
Yeah, I tend to agree. And if you look back at the UK gas market years ago, before the NBP, everyone traded at various different entry points. The St Fergus traded, Bacton traded, and that's because that was where the physical gas was landing. When the NBP came into force, all liquidity went there, and it disappeared from the other places. But to the extent that you ended up with a much more efficient market and one which was much deeper from a liquidity perspective.
One more question? Yes, we have one here.
It's George Grant for Olivia's a very softball question, but your summary slides for spot market and forward market had some red figures which had sort of percentage increases and decreases. Are those annual figures, or you didn't tell us what those were?
I have to flip back. Yeah, so for the forwards, it's the note at the bottom says it's based on OTC and exchange spot traded volumes from January to August 2012. But I would have to go back and double check that, to be honest. There's all sorts of different ways you can mix these figures, but as everyone will know. But I mean, I think the general message is the dominance of MBP, which no matter how people mix the figures, is normally, well, it's always the story.
Okay, thank you very much. Can I ask you to show your appreciation to Christian and Olivia?